Good afternoon, ladies and gentlemen. Greetings and welcome to Canaccord Wealth's latest client update webinar. I'm pleased and slightly alarmed to say this is our second webinar in the last week, which probably tells you there's quite a lot going on in the world. My name's Tom Becket and I'm the Co-Chief Investment Officer here at Canaccord Wealth. And today's subject, which probably explains why there's two webinars in a week, is what's happening in the US and the likely impact of the US election on the US economy and, of course, the global economy. And most importantly for you and your portfolios, what might happen to financial markets in the next couple of weeks, months, quarters, and indeed years. Now, obviously, that's quite a complicated subject. And of course, lots of you having heard from me only last week, I'm delighted to say that we've brought in a special guest today, who is Ron Temple, who is the Chief Market Strategist at Lazard Asset Management. And Ron and I have known each other for the last 15 years, and he's been very much my go-to man when having to ask complicated questions about financial markets and indeed the situation in the US. So Ron, thanks a lot for joining us today. And I'm particularly pleased to join us. It's about 6 a.m. in the morning where you are. So thank you very much indeed for putting up with me. There are lots of questions we could ask today and lots of questions have come in from our clients. But I think before we start to shine a light upon what's happening in the US political backdrop, let's focus in on the economy first of all. And as we head towards this extremely seismic election in a few weeks' time, how is the US economy actually faring as we head towards polling day?
Yeah, well, first of all, Tom, it's a pleasure to be here. Thanks for inviting me. I'm glad you started with the economy because it's always good to get that context. When I look at the US economy, it's in a pretty good place. I guess if you look at the last 2 years, or even the last 3.5 years, inflation has been the story. But the other story that got buried under the inflation was that the economy's been growing effectively above potential. Most economists would say a sustainable growth rate for the US, 1.7 to 2%. We've grown at 2.5% last year. The consensus for 2024 is that we'll finish the year around 2.6%. So strong economic growth. And the good news is over the last, say, 24 months, inflation has slowed significantly. So we peaked at a 9.1% inflation rate on a headline basis, which means that includes food and energy. We're down to around a 2.5% level. And if you look at core, we peaked at 6.6. We're down to just over 3. So encouraging signs on inflation. Part of what's driven that decline in inflation, by the way, is all the rate hikes from the Fed that have slowed demand. We have seen basically the labor market was incredibly tight. If you go back to early 2022, there were 2 unfilled jobs for every unemployed worker. That's now come down to 1.2. The unemployment rate was at a 54-year low of 3.4%. We're now at 4.05%. So again, you've seen a little bit of leveling off that led some people to be worried about a recession even a few weeks ago before we got the labor report for September. I think we're in a really good position. We are slowing. I think when you look at 2025, growth is likely to be closer to 2%, down from that 2.5. But again, as I mentioned before, that's what most economists would say is a sustainable level. So think of it this way. We've been growing above the speed limit. We'll probably grow right around the speed limit over the next couple of years. So a pretty good backdrop. One last comment, by the way. If you look at surveys of Americans, they would say something very different, right? They would say the economy's on the wrong track. And I think what you really see there is the scar tissue of the inflation. This is the first time we've had high inflation since the early 1980s. So for most adults in the United States, it's a first-time event. And for many of them, I think there's also confusion that even though the macro stats say inflation has come down, they're still saying, well, my grocery prices haven't gone down. I think that's obviously an unrealistic expectation. Prices typically don't go back down. Instead, wages recalibrate to the higher price level. And so I think that's a bit of the disconnect you see on the surveys.
Yeah, and I think there's also probably an element, we talk about the political stuff in a minute, where the last 15 years has been a very different experience for the haves in society versus the have-nots, which does explain
absolutely
the political volatility that we're seeing. As you rightly pointed out at the start, that's a more complicated subject than the economy. And again, I made these comments last week on our last client update webinar, but we're in a situation where economic activity is slowing, but that's what the central banks wanted. Inflation is certainly looking like it's coming under control. We might not get to the same levels that we did in the last decade, but we're in a very different place we were a few years ago. And that's now meaning that we're starting interest rate cutting cycles across most developed world economies, including most recently in the US. That's probably the right course of action here, isn't it?
I think so. I mean, the big surprise in the U.S. was that the Fed decided to make a big cut as their first cut. So, typically you would expect them to kind of ease into an easing cycle. Sorry for the redundancy. But, instead of a 25 basis point rate cut, we got a 50. And I think it was an interesting confluence of events there where the last Fed meeting was July 31st, followed by September 18th. September 18th, we got 50 basis points. The July 31st date was really inconvenient in that literally a few days later, we got the July employment report, which showed a much weaker than expected job creation number and also had a downward revision to the June job report. And so that basically raised concerns that maybe the economy was slowing more than we would desire. Again, there's a level of desired slowing to get inflation in check, but not that we slip into a recession. And so I think when the Fed looked at that data, they basically had to step back and remind themselves they have two mandates, right? They have a price stability mandate and a maximum employment mandate. And Jay Powell on August 23rd in his Jackson Hole speech made it very clear that it was time for the Fed to look at both legs of the mandate, where for the last 2 years, they've actually, for the first time in my life, been saying very explicitly that price stability was a precondition for maximum employment. So they effectively had told the markets that price stability was more important than jobs for 2 years. Now they're kind of recalibrating that. And they decided that they should basically take out an insurance policy by cutting by 50 basis points, which I think was a wise choice. Now, subsequently, we've gotten upward revisions to those job numbers. We've gotten a much stronger job report for September. So I do not think anyone should expect additional 50 basis point rate cuts in the near term anyway, unless we have a surprising turn of events on the economy.
Yeah, I mean, I think the very simple truth is that whilst 5.25% might have been suitable interest rates a couple of years ago, that's now outdated, and the Fed needed to act. I think one of the big questions, particularly from the Donald Trump camp, would be whether or not those interest rate cuts needed to come quite so soon before what's likely to be an extremely toxic presidential election. So has the Fed here become political, or are they just purely focusing in on the numbers?
I think they're purely focused on the numbers. And I do find it ironic that if Donald Trump were in the White House, they would have said they should have cut by 50 a month before. So, I think this is the downside of politicians talking about monetary policy. And as much as, by the way, President Biden praised the Fed after the fact, historically, presidents have not opined in advance of a Fed decision. Maybe here and there. I think Trump might be the one who's done that in the last 20 years. And I think it's incredibly important, by the way, that we maintain as much Fed independence as possible. And I say it that way because, again, I don't want to sound naive or ignorant of the situation. The Fed, the headquarters of the Fed is in Washington, D.C. Inherently, there is a political element because Fed governors are appointed by the president on the Federal Reserve Board, not the regional presidents. And so, I'm sure there is a tinge of political risk there. But one thing I've always respected about the Fed is absent one Fed official in the last 30 years, I don't think a single Fed governor has given money to a political candidate. They're always extremely careful to avoid being seen as favoring either side. And I think that's still the case. I think they made a call that most economists would say is the right call. And I would, last but not least, note that a number of these Fed governors were appointed by Republicans, including Donald Trump. And I might note Jay Powell himself was appointed by Donald Trump. So, if we start saying it's politics, and it's really hard to tell where that ends.
No, absolutely. And, Donald Trump could have turned it into a positive and said, look, they're having to cut interest rates because the economy stinks. I mean, so we're in silly season and we do appreciate that. But we have managed to neatly segue from the economy and interest rates into the political cycle. So, and I suspect this is that and what might happen with US equities after the election, the two reasons that people have really dialed in today. So, as we read it reported here, and there's been an interesting shift actually since you and I had lunch last Wednesday. This time last week, both the betting markets and indeed the polls had Harris as a marginal favour. There's been a bit of a divergence in the last week, and whilst the polls are still leaning a little bit towards Kamala Harris, but she does need them to because of the way the Electoral College is shaped up, and we'll talk about that in a minute. The betting markets have moved considerably in Trump's favour in the last week. So how would you describe the current matchup? And whose camp would you rather be in at this point in time, or is it really still a case of this is a coin toss? It really is too close to call.
I think it's still too close to call. I mean, honestly, I've debated in my own mind whether I should even look at the betting markets because it's not clear to me what extra insight someone punting on an election would have relative to the data you and I have. And I frankly don't think there's any incremental insight there. I think also the polls are really hard to have high confidence in. It's because I guess the biggest issue to me is voter turnout will determine this election. And if you go back to 2020, 66.8% of eligible Americans voted. Importantly, 70% of them voted before Election Day. So, we're a month into this election already. In Pennsylvania, ballots started going out on September 16th. That is probably the critical swing state. So when we look at these polls, a snapshot of today's opinion might not reflect the number of people who've already voted. It might not reflect that this year we've seen, or at least over the last 2 to 3 years since the Supreme Court overturned reproductive rights for women in terms of abortion, we've seen very high turnout amongst women and younger people in certain referenda around those rights. Well, this year in Arizona, there's a constitutional amendment on abortion. So I don't know how well a poll could basically predict the demographics of the turnout in Arizona on November 5th or all the days before that. So I guess that's a real challenge. And I think the safest bet is it's going to be close. Okay. The one thing I think will not be close is the U.S. Senate is likely to go Republican. That's easier to predict. But the House of Representatives and the White House, I would not want to be betting large sums of money on the outcome either way.
Now, I must point out that Ron is currently based in Las Vegas, Nevada for one day, and he's dialing into us at 6 o'clock in the morning. So that proves he's not there to try and place some bets on the US election. He's much rather would obviously speak to me, despite that being somewhat of a Hobson's choice. But let's move on now and talk about the Electoral College system, because this is a really important point here. You mentioned Pennsylvania and Arizona, two obvious points of political conflict, but one of the reasons the betting markets might have moved in the last week or so is because the Democratic camps in both Wisconsin and Michigan are suggesting that this could be a bit more of a concerning situation than they thought only a few weeks ago. So why does all this matter, these individual particular states?
Yeah, and by the way, it's interesting. I was having this conversation with a colleague yesterday because Kamala Harris has now agreed to be interviewed by Fox News for the first time in this campaign, and she's looking at going on the Joe Rogan show. In a range of kind of media outlets, she's considering that historically would have been a bit surprising. And the question was, is she panicking or is she confident? And I don't know if panic's the word, but I think there is concern in the camp. So you're absolutely right about that. When it comes to the Electoral College, the way it's designed, and I'll try to keep this short, is each state in the United States gets a certain number of electoral votes, which is determined by the number of seats in the House of Representatives and the Senate. Well, every state in the U.S. has 2 seats in the Senate. The seats in the House are driven by population. Now, because every state gets 2 seats in the Senate, that skews the representation of less populated states. So to put a finer point on this, Wyoming has 1 electoral vote for every 170,000 residents. California gets 1 electoral vote for every 720,000 residents. And effectively, all you need to win all of the electoral votes for a state is to win that state by 1 vote. It is a winner takes all, state by state, with 2 minor exceptions, which we don't need to dig into, which are in Maine and in Missouri. But bottom line is, the way the voting typically stacks up is Democrats tend to pile up a lot of extra votes in California and New York. Give you a sense, by the way, in the 2016 election, Hillary Clinton won 90% of the votes in New York City. And basically that was kind of a waste because all those extra votes don't get you a single extra electoral vote. Republicans, by the way, tend to pile up extra votes in those rural states, but they are getting disproportionate representation from that in the Electoral College. But they also tend to get extra votes in Texas, for example, and probably this year in Florida. So it really comes down to when you start forecasting the map, I can tell you with almost unquestioned certainty that Kamala Harris is going to have over 200 electoral votes and Donald Trump will have over 200 electoral votes because there are certain states you just know are going to go to one side. The problem is there are 538 electoral votes in total, so you need 270 to win. And yes, quick sidebar, you can actually have a tie because there are 538 votes. All 50 states and the District of Columbia get electoral votes. If there's a tie, the House of Representatives decides with each state getting 1 vote, which means Donald Trump would win. But bottom line, it really comes down to 7 swing states. You mentioned Arizona, Pennsylvania, Michigan, Wisconsin, North Carolina, Georgia, and of course I forgot, Nevada, right. Coincidentally where I'm sitting. So effectively, those are the 7 states we'll all be watching on election night. The other thing I would suggest you watch on election night, because I don't think you'll know the outcome on the morning of November 6th, is watch to see how historically Democratic states, for example, like Virginia, trend. If Democrats win by a larger margin in Virginia than they did in 2020, that might be a positive sign that they'll do better in North Carolina, which is just next door. You can also watch other states just for margin of victory versus past margins. But again, this year, the demographic mix of who's supporting Trump versus Harris has really been mixed up quite a bit, with non-white voters being more prone to vote for Donald Trump, especially male non-white voters, and women being more prone to vote for Kamala Harris. So it's going to be a very interesting week around November 5th. And I say week because I think it might take a while for us to know the outcome.
Well, I think they're actually counting the ballots in Georgia by hand this time around, aren't they? So that in itself.
Yeah. Which does take longer and also introduces a higher risk of error, which is in theory what it was all presumed to avoid. But yeah. And by the way, the one last one is Pennsylvania. I mentioned voting started on September 16th. Pennsylvania has a state law that's been there for some time that you're not allowed to even open the envelopes until November 5th to start counting. And when you're opening the envelopes, by the way, you have to validate the signature on the envelope. There's a whole process. So I think Pennsylvania could easily take 2-3 more weeks to figure out who won there, and that could be the state that decides the election.
Not necessarily a long week, could be long weeks, and imagine they'd be quite well is the answer. So that's not much to look forward to in the run up to Christmas. But so you mentioned within that the House of Representatives and the presidential election themselves still, for whatever the papers might say, appear to be a coin toss to all intents and purposes. The Senate looks more certain to go towards the Republicans. So that in itself throws up different outcomes, because presumably if Donald Trump was to win the keys to 1600 Pennsylvania Avenue in the White House and the Senate was to be controlled by the Republicans, that does open up different scenarios, doesn't it?
Yeah. No, I think there are basically two primary scenarios you should think about as investors. One is if Donald Trump wins, that means he got his base out to vote, that the population supported his policies. And in that event, I would think the House of Representatives is likely to go Republican as well, which implies that you get a Republican House, Senate, White House. In the other scenario, I think you get Kamala Harris, same story, gets her base out to vote, the demographics swing in her favor. And that probably means the Democrats win the House and the White House, but have a Republican Senate. So it is a very different situation. It's not a symmetrical Democrats control everything or Republicans control everything. And the reason I say 80% chance Republicans control the Senate, by the way, the Senate right now is 51 Democrat, 49 Republican. One of the Democrats who's retiring will almost certainly be replaced by a Republican in West Virginia. That gives you 50-50. There are 7 other Senate seats that are very close within the margin of error or leaning in favor of the Republican, and they're all seats held by Democrats. So the probability of the Democrats losing at least one, if not 2 of those seats seems quite high. So bottom line is when it comes to kind of policy implications, in one scenario, Donald Trump likely has relatively free reign to pass his policies through the House and Senate, whereas under a Kamala Harris administration, it's highly likely that she would run into basically obstruction or resistance in the Senate to some of her plans to raise corporate taxes, for example.
Yeah, and let's be honest about it. One of the reasons that your political system, your fabulous country, was created the way it was to try and, block too much power for any one person or any one part of the government, and that's why it's always worked pretty well. So with those scenarios in mind, the 2 biggest risks presumably are, and the fiscal situation in the US is also by historical observances pretty extreme as we see now. I mean, the US government is spending money like it's going out of fashion. And of course, the last few years have been dominated by COVID payments or things like that. But even as we've emerged from that in a strong economic situation, the US government is spending way more than it's bringing in.
Yeah.
The chances are, under both of the candidates vying for the presidency, this continues. But the suspicions are it's more under Trump than under Harris. So perhaps we could talk about that as one part of the economic scenario going forwards. It's always interesting. No one seems to care about these things either, which is quite interesting.
Right.
The second thing particularly, which I know you're worried about, is the whole concept of tariffs. Perhaps you could
Yeah.
explain why that's important, particularly with regards to the Trump administration, because Biden administration has put on a number of tariffs, but this is expected to go into turbocharge under President Trump.
Yeah. So let's start with the fiscal outlook, because under either candidate, it's unsustainable. It's interesting. Deutsche Bank put out a report in the last hour where they're forecasting different deficit scenarios under different scenarios, and under different kind of permutations of the election outcome. And the forecast under a Trump victory with Republican control of the House and Senate was deficits of anywhere from 7.5% to 9% of GDP over each year for the next 3 to 4 years. So again, even higher than current levels. Under a Kamala Harris with a Republican Senate, unsurprisingly, the deficits are lower because she would not be able to spend the money she wants to spend, but she also might not be able to raise some of the taxes she wants to raise. But you bottom even ended up there with 6.5% to 8% of GDP deficit. So either way, too high. And so I do think that's a real problem for the U.S. And to be honest, you mentioned silly season. Over the last few weeks, each day I feel like I'm waking up with a new proposal of a tax that's going to go away. So for example, Trump recently proposed making the interest on auto loans tax deductible. Now, by the way, that's a bit of a gimmick because the only people who itemize at that level are very high income people who would be deducting the interest on their Bentley. But bottom line is you're basically going to see both of them proposing no taxes on tips in restaurants, and anyone who's visited the U.S. knows that we tip extremely excessively. So effectively, you basically got Christmas coming from the politicians every day, it seems, in terms of taxes. So bottom line, no change on the deficit. The tariff issue really concerns me. And I think most investors are underestimating how important this is. And each time I get incremental information on this from people in the Trump orbit, it makes me more worried. And in particular, what Trump has proposed is a 10% tariff on all imports into the United States, regardless of the source, and a 60% tariff on imports from China. Now, to give you a context, by the way, when Trump became president, the weighted average tariff on imports into the U.S. was 1.5%. By the time he left the White House, it was 3%. If you put on a 10% global tariff, obviously that implies you're going to 10 from where you are at 3. But if you add on the 60% on Chinese exports to the U.S., you actually get a blended tariff of 20%. So you'd be talking about taking the tariff on $3.7 trillion a year of imports from 3% to 20%. That would be the highest tariff since the 1930s. And my concern with that is multifaceted. Number one is it raises inflation because you're raising prices on things consumers and companies in the U.S. buy, whether it's final goods or intermediate goods going into a production process. Number two is it reduces U.S. GDP because you introduce this payment shock or cost shock for American companies and consumers. And number three, it's very disruptive for corporate supply chains and would hit corporate profit margins significantly in some cases. Now, that last point is really important because for some companies, there's no impact. If you're a financial service company, you don't import anything. If you're a domestic energy company, you probably do not import anything. So the tariffs would not affect those sectors. But if you're a consumer discretionary company, let's say you're a clothing retailer and you import a large portion of your inventory from China, you're going to face a significant price shock. You have to then decide if you're going to pass on to your customers. If you're in the tech hardware chain, you're going to face these tariffs. And by the way, I haven't even gotten to the idea of retaliation, because clearly if the US puts a 10% tariff on everything from the UK government's not going to sit on its hands. It has to respond. And historically, what we've seen is different types of responses, whether it be comparable size tariffs from the European Union or restrictions on exports from China. And so I think this could be very disruptive. And one last thing, you kind of intimated about this in your question. This is something the president does with no involvement of Congress. The president has sole latitude to raise or lower tariffs because of acts Congress took over the last 50 years to give the president that freedom. And so I do not think on day one, Donald Trump would put in place a 60% tariff on China. But what I do think would happen is over the next 1 to 2 years after getting elected, we could see tariffs go to 60% as part of a negotiating back and forth between Trump and China, trying to demand more, imports into China of American goods or to demand other agreements. And I don't think this is being priced into markets. Most investors I talk to globally say to me, oh, Trump won't do it, it's bad for the economy, but I think that is completely misplaced confidence. Now, you mentioned Biden put tariffs into place. That is true. But if you look at the tariffs Biden put into place most recently, it was on $18 billion of Chinese goods. What Trump is talking about is $450 billion of Chinese goods. So just the quantum is completely different. And what Biden and presumably Harris would be focused on is much more focused on de-risking the U.S. exposure to China. So, for example, the last Biden tariffs were related to electric vehicles, but they were also related to syringes. There's a concern that we learned during the pandemic that most Western countries are way too reliant on China and certain other countries for PPE. And so I think there's a desire to reduce that risk. And the bigger focus of Biden's trade policies, which I think would be extended or continued under Trump, has been restricting outbound flow to China of certain key technologies and biotech. Again, more national security driven. And the reason, and this is important, by the way, for Biden, this has all been about kind of containing the rise of China and its technological and military capabilities. With Trump, it's also that topic, but secondarily or primarily maybe, it's also that Trump thinks it's incredibly important to reduce the trade deficit, and his idea is to do that through tariffs.
Well,
sorry, that was a lot.
No, tariffs in simple terms could be a bad idea here, and increasing isolationist and multipolar approach to the world would be another contributing factor behind the turbulent 20s framework that we've talked about here at Canaccord for some years, and does definitely contribute towards volatility in economic outcomes, inflation, therefore interest rates and financial markets too. It just makes it a much more difficult operating environment. You did mention tax.
If I can add one last thing, by the way, I typical American, I focused on the U.S. The impact of these tariffs outside the U.S. is actually worse on non-U.S. countries than it is on the U.S. I mean, one of the analyses I've seen is that China's GDP would go down 2.5 percentage points if the U.S. put this tariff on China. The Eurozone GDP would go down 100 basis points. So if you also put this in a global context, you've got economic fragility in the Eurozone, and I think some pretty significant fragility in China. It adds to that volatility as well. Sorry to interrupt there.
Well, it probably drives both of those major economies into recession. So, that in itself would be a big problem for a world that's become increasingly interconnected in the last few decades, even if there is an element of that rowing back at the moment. You did mention tax cuts there. I hope that some of those are going to come across the Atlantic as well. I haven't got that impression so far from our new government, but let's move swiftly on. So in terms of what also might be affected with the outcome of the election, just put into context some of the, and I appreciate there's a lot of hot noise and hot air around this, and in terms of the geopolitical relationships and potentially how a Trump administration would progress with some of the allies and some of the enemies of the world that the US currently faces.
And forgive me, one last thing on the markets topic. You mentioned tax cuts. Trump does want to cut corporate taxes, and he also has talked about deregulating certain parts of the economy. So I don't want to leave people with the idea that you need to sell all your equities if Trump gets elected. I think what's important is you'll probably see some parts of the market do very well in response to a Trump election, like financials and energy, and other sectors do poorly. So again, I think you got a rotation like you saw in 2016, and outside the US, you would probably see differing effects across sectors and companies. So that's, I don't want to leave you with just a purely negative view. It's more of a rotational view. You might want to think about opportunities and risk in your existing portfolio. On the geopolitical front, the biggest issues on that front, really, well, again, I hate to sound like a broken record. I think with Kamala Harris, it's largely a case of continuity with Joe Biden on a geopolitical side. The one case where I think you might see a different approach is vis-a-vis Israel and the conflict with Gaza, Hezbollah, the Houthis, and increasingly Iran. I think the U.S. will always say it has an ironclad, relationship with Israel and will always defend Israel's sovereignty and safety. But I do think behind closed doors, Kamala would be more forceful about limitations on what Israel is doing from a humanitarian perspective. Biden has had a lifelong affinity with Israel that kind of, in some ways, is understandable, but also to some people, especially younger Americans, is somewhat inexplicable. He's literally, maybe the upside of being 80 years old is you have relationships with many generations of leaders. And so again, there's a personal commitment for Biden that I don't think is necessarily the same with Kamala. And again, it's not that she's anti-Israel or anything like that. It's just a different degree of support. So I think that would be one issue that would be one area that might change. But I think on NATO, Ukraine, China, relations with the EU and the UK, largely continuity. With Trump, he has talked while he was president and since he's president about NATO and about the basically failure of NATO allies to spend 2% of GDP on defense. It's interesting when you look at some of the former support advisors of Trump, including his own national security advisor. Their view is that this is entirely a talking point to justify the U.S. exiting NATO. Not that Trump necessarily cares if people spend 2%. He just wants to put the excuse out there. That might be an extreme view, but the bottom line is Trump's commitment to NATO is more questionable than any other Republican or Democratic president I've seen in my lifetime. This has never been a partisan issue. The old expression in the U.S. was politics end at the water's edge. Unfortunately, that seems to have changed. And so one issue on the geopolitical front is whether the U.S. would be committed to NATO. The most telling comment from Trump was that he basically said if anyone's spending less than 2% of GDP on their defense, that Putin could do whatever the hell he wants. The good news is the countries that spend the most on defense in NATO are the ones that are closest to Russia. So hopefully we don't have to worry about Putin testing out that theory if Trump is president. The other topic is Trump has said he would end the war in Ukraine within 24 hours. Even a few weeks ago when Zelensky was in New York for the UN General Assembly, he met with Trump, and Trump said at a press conference or a press briefing with Zelensky how they both want the war to end as soon as possible. And you could see the discomfort from Zelensky because he does not want the war to end right now at the current lines of the boundaries. And so I think the worry there is that what would probably happen is Trump would basically tell Zelensky privately or publicly that U.S. aid is going to stop and that he has to negotiate, and that he would also, in theory, threaten Putin and say, hey, unless you negotiate with Zelensky, we're going to keep giving them aid. But I doubt Putin would believe that. I think that wouldn't be a hand well played in Vegas, because we all know recently that there is an affinity between Trump and Putin, whether it be sending masks during COVID or staying in contact after leaving the presidency. And I would remind you, by the way, in case anyone's forgotten, that Trump does not particularly like Zelensky on a personal basis, because Zelensky refused to play ball around Hunter Biden and political scandals during the 2020 campaign. So I think Ukraine is one issue. And then the last issue that's incredibly important is China. And I bring this up last but not least because if you're sitting in Beijing and you're watching the U.S. where questions are being raised about commitment to NATO after 75 years, where the U.S. is willing to potentially shut off funding to Ukraine, turning on a dime because of an election, it has to raise questions about the U.S. commitment to Taiwan. And this is particularly timely, given that in the last 48 hours, we had the biggest incursion into Taiwanese airspace ever by Chinese planes, largely in response to an annual day speech from the president of Taiwan. And effectively, this is where it gets more confusing, is Trump has made explicit comments in the past about questioning why the U.S. would defend Taiwan, questioning if the U.S. could defend Taiwan. On the other hand, his most senior advisors, or the people we think are most likely to be appointed in his administration, are very hawkish around Taiwan and have been even more strident than most other politicians. In fact, one of them, Mike Pompeo, who is speculated to potentially be the Secretary of State, has called for the U.S. to recognize Taiwan's independence, which is a bright red line for the Chinese. So, it'll be interesting to see where this plays out. But my concern is the Chinese are already pushing the envelope territorially. I worry that they would be even more tempted with a Trump presidency to see how far they could go. And that increases the risk in the Indo-Pacific region. And by the way, raises the risk for all those other U.S. allies we've been trying to line up around China, including the Philippines, Vietnam, South Korea, Japan, as kind of, a perimeter that would help defend Taiwan. If they start to question U.S. commitment, then does this whole deterrence effort start to crumble, which increases the likelihood of conflict because of basically a perception of weakness or lack of commitment?
Well, of course, and as we know through history, it ratchets up the tension and creates a greater chance of some accident or mishap taking place. Yep. That really becomes a real concern with the increase in volatility about geopolitical outcomes, which would almost certainly come under a Trump administration, no matter what he might say on his various different social media feeds. Let's finish off on easier, well, hopefully easier ground. Actually, it is quite easy because the last 10 years, really, your investment success or failure rate has been dictated by how you've approached investing in the US. The US has just become omnipotent, and the size of the financial markets there were very large by comparison to other global markets 10 years ago, and now they just dwarf them. Do you expect that omnipotence to continue? I mean, even under the most negative scenario of race today, where Trump wins, there's a Republican sweep, the tariffs come in place. At the same time, you could have the offsetting factor of corporate tax cuts, brackets not
Yep.
pay the right tax rates anyway, but put that on one side.
Right.
Even in that environment, the US could be a bastion of growth and a safe haven by comparison to other parts of the world. But will that omnipotence carry on?
Yeah, I mean, I fear the word omnipotence because it just seems like one of those words you say right before it all goes horribly wrong. But
Well,
but I do think
we've had omnipotence quite a long time classic, so they tend to go well around then. Don't worry.
so no, I mean, but I do think your point about an relative outperformance could persist even in that scenario with a global trade war, because the U.S. economy is less dependent on trade. It's less susceptible to retaliation. For example, we import 3 times as much each year from China as China imports from the U.S. So again, there's more vulnerability on the other side of the table. But I guess I'm reluctant to say that outperformance can go on forever, because it can't. There are periods of time where markets do basically shift in terms of preferences. I guess you mentioned your own government. I'm hoping that your government can find ways to invigorate growth, at least on the margin. But honestly, one of the negative side effects of this whole conversation we just had about geopolitics is I do believe, regardless who the president is, even under a Kamala Harris president, UK and the rest of Europe are going to have to spend more on defense. And I don't know where you're going to find the money when budgets are so stressed, right? So this is going to be a more troubling world, regardless of US politics in that regard, from a fiscal stress perspective. But to your point, when I think about the growth engines for the next decade, it's not going to be banks and it's not going to be, retailers. It's probably going to be topics around AI. It's going to be around the energy transition, which still has to happen regardless who the president is. It's going to be around innovation in healthcare. And when I look at who leads in that space, it's an interesting mix. On AI and on the healthcare front, I think the US has some world-class category killer companies, but so does China, right? Now, again, that's part of the whole geopolitical effort, is the US is trying to curtail the flow of certain instruments that can be used to advance AI in China. And we're doing that with allies, in the Netherlands, in Korea, and Japan. But I do think, on those growth engines, the US and China would be particularly well placed. I would much prefer the US in that regard, because I think you're going to have more tensions over that with China, and the US is going to do everything it can to slow their growth. On healthcare, Europe has obviously had some champions there. Again, continental Europe. So I'm reluctant to say that you should, my bias is you should be picking the company regardless of the domicile of the headquarters, just because, as you know better than anyone, I believe 75% of FTSE 100 revenue is not generated in the UK. And so, but that said, the US economy is probably going to be more dynamic than any other any other large developed economy over the next 4 to 6 years, even under a Trump. I just worry that the volatility investors are going to face globally if you do get that Trump election could be one that's, maybe I don't know if I want to say unparalleled, but it could be. Under Kamala Harris, maybe it's a bit more status quo, a little less exciting, but personally, I prefer to earn my 8% return without the volatility. And so maybe that's a better environment. But bottom line is, I'm kind of dodging your question and saying it really all comes down to the securities you're selecting. I do think the U.S. is well positioned to continue to do well. But I mean, one last point I would make, I mentioned at the very beginning, I expect the U.S. economy to decelerate toward the speed limit next year. In contrast, the Eurozone is likely to accelerate. And so, I do think there are markets outside the U.S., especially if we get a Harris victory, where you could actually have some pretty good opportunities, whether it be Japanese equities, longer term EM outside of China, as these China tensions ratchet up. I think a lot of companies globally are trying to figure out if they should move their operations to India or Mexico or Thailand. They're not trying to decide between Spain and South Carolina. So I think there are a lot of opportunities in the world. US is well positioned, but there are quite a few options outside the US as well.
Well, thank you, Ron. That was absolutely excellent. And of course, the geopolitical and market volatility might not be easy for us to deal with, but it does keep us in a job and prevents AI from taking over immediately. But I think just to sum up from a market perspective, I mean, our views would be similar to yours. There is going to be a number of active opportunities, no matter who wins the keys to the White House. It might just be you need to think differently about how you shape your portfolios. But that's, of course, what you and I are paid to do for our respective jobs. And ultimately, whether it's been a Republican president or a Democrat president, markets have typically gone up, just at different rates and with different levels of volatility. Markets will almost certainly go up in the future. Well, let's very much hope so. So I think the opportunity to make money is there. I think after 2 years of really substantial outsized gains from investment markets, it's likely to be a bit harder going forwards. But to say there were no investment opportunities around the world would completely miss the point from both of our perspectives. And that's what gives us confidence in achieving our clients' aims and ambitions, and gives us lots of stuff to write about in forthcoming newsletters. So, Ron, thanks so much indeed for joining us. Very early morning for you in Las Vegas, and thanks very much indeed to everyone for joining us this afternoon and sending in questions beforehand. Should you have any further questions on this subject or any other subject, you're welcome to send them to me directly or your Canaccord representative, and the particularly hard ones I'll send over to Ron. Thank you very much indeed for your time, and thank you, Ron.
Thank you, Tom. Great to be here.